Welcome to this video, and in this video I'm going to talk about 5 different ways to fund a property deal. Now, each one of them has its pros and cons, so we'll break them down throughout this video. And I'm standing in a property that I bought, refurbished and refinanced, so what better place to talk about funding. Now, this particular one I funded with the first method, which I appreciate is not available at all times to all people, which is buying a property for cash. Now, the pros of buying for cash is it can give you extra negotiating power because people don't have to worry about you securing funding. And it can help you to move faster if you've got a highly motivated seller and the deal needs to be done very quickly. The con, of course, is not everybody's got 300, 400, 500 grand available to spend on a particular property, but that's not the only con. Another con to potentially using cash is whilst you've got your cash tied up in a property, it might stop you from doing another deal. So for example, if I tied up 400 grand into this property deal, maybe I could have tied up 200 and borrowed a bit and then gone and done another one at 200 and borrowed a bit and done 2 properties in 6 months rather than 1 in 6 months. So speed and efficiency is a factor to consider as well when we're breaking down the pros and cons. The number 2 way to fund a project, I'll keep it super simple to start off with, is just getting a mortgage. Most of you be familiar with that. Mortgage works by putting down a deposit on the property. Usually they start at around 25%. You will see some properties and some mortgage providers that will offer 80% loan to value, meaning you put down 20%. Now, loan to value, for those that aren't familiar with the terminology, is basically the size of the loan in comparison to the value of the property. So if I've got a £400,000 property and I take out a £300,000 mortgage, then what that equates to is a 75% loan to value, loan in comparison to the value. Just breaking that down so we understand some of the terminology behind what's going on as well. Now, pros to a mortgage are generally fairly straightforward to secure, provided the revenues there from the property, especially in a limited company, tend to be a bit easier in terms of passing affordability. So if it's a buy to let, they'll want to look at how much profit is or cash is the property going to generate. So they'll look at what we call rental affordability. So will it make enough rent? Now, the simple formula for that is, let's say they're going to lend you money and your mortgage will be £1,000 a month. The minimum rent that it will need to make for a limited company would be 1.25 times the mortgage. So that would be £1,250 a month. And that's based not on your valuation or what the tenancy agreement you've got your mate to sign is. That's based on what a RICS chartered surveyor comes through and says the rental valuation is. So if you go and get a higher rent, the value will go, well, that's good for you, but we're still valuing the rent at what we believe the rent value is. So just keep that in mind, those of you that might be finding paperwork to suit your needs. Now, mortgages are good because they're generally fairly straightforward, generally reasonable interest rates. They're much lower lending than some of the other lending we're going to talk about in this video. However, what I will say is the con of a mortgage is you're tying your cash in usually for a minimum of 2 years. If you're buying a property and adding value, it might not always be the most suitable approach unless you're not in a rush to refinance your cash back out. That's the downside of potentially using a mortgage. So if you're buying a property and you just want to put a deposit mortgage and leave it be and go up in value over time, fine. But if you're dependent on that cash to do your next project, a mortgage might not be simple or the straightforward way. Now, in fact, mortgage is long-term lending. A lot of people don't know that the term mortgage comes from the French mort, meaning death, is a loan until death. There's something nice and morbid for you about mortgages. Now, that's the second type of lending that we could potentially use. Let's get a little bit more complex now. We look at the third type of lending, and that's bridging. Now, that bridging is effectively short-term finance. Now, as the name suggests, what you're doing is bridging the gap from when you buy the property to when you finance or exit the property. So it's made for short-term lending. Most bridges will run between 3 to 12 months. Most bridges, I'm generalizing because they're all very different because they come from very different lenders. Most bridges will be calculated on a monthly basis and will have fees associated. So let's talk about the pros. The pros of bridging are that you can generally move quite quick as long as you've got a clear exit. You can raise funds on a particular property, which is great, and you can refinance and repay that loan. So that's a pro. So it's great for something like a flip or a BRR. The cons, and this is one you really need to be clear on, is the potential cost of a bridge. Now, what you have to factor in are the arrangement fees. potentially exit fees, paying their solicitors, and any other administrative legal fees that may be added on to that particular loan. I'll give you an example. If we've got a bridge for £250,000 and they say, well, it's 1% a month, you might go, okay, well, that's easy to calculate. It's £2,500 a month. And now when you add a 2% arrangement fee at £5,000 and maybe a 2% exit fee, that's another £5,000 and £2,000 for solicitors fees, and again whatever other fees they might rustle up. So for example, you're usually going to pay for a valuation, and it's a big valuation because it's not just the current value, they're doing a current and a final value valuation, so that could be another £1,000 to £2,000 depending on the size and scale of the project. You could be running into tens of thousands of pounds just in fees. So it's critical that you know your numbers before you use a bridge, but it's a great approach. Now, one of the potential cons of a bridge is you still need a deposit. So a lot of them will take 25% deposit and have 75% loan to value, but it's worth keeping in mind that some bridge lenders will actually allow you to borrow more than the value of the property. So you can get some that will lend you refurbishment costs on top as well. So let's say 400 grand property, you want to borrow, put 100 down, take a 300 grand bridge to buy it, but you might also want to borrow some 30k or whatever else on top in order to carry out the refurb. Again, you've got to do your numbers on that, but that might allow you to stretch a little bit higher on your project and do a slightly bigger project than you would have otherwise maybe done. So that's bridging finance. Super useful. In order to get a bridge, never go directly to a bridge provider. Always get yourself a good broker and make sure that you're picking the best and most suitable product for you. Watch out for bridging terms. Make sure you understand them, because if you're new to the bridging world, there are things that could trip you up. I'll give you a simple example. They can give you what they call a deducted bridge. Now, I gave that example of a 400k house with a 300k bridge. What some bridging providers will do, which I think is a little bit cheeky, but remember the golden rule, he who has the gold makes the rules. What some bridging providers will do is they'll say, yeah, we'll lend you 300k, but we're going to do it on deducted terms. Now what that means is they deduct the interest for the entire year up front from you. So say, yeah, we're not actually going to give you the 300, we're going to give you the 300 minus the year's worth of interest. Now in that scenario, what would that be? 3 times 36, maybe 36k they're going to take off and then give you the remaining balance. Which actually means you're not really getting the entire amount and you're going to have to put more in on the front end as well. So again, watch out for things like that. Make sure you really understand, read and understand those terms. And if you're not sure, get a mentor, coach or somebody to support you and talk you through that as well, so we don't get our fingers burnt. Number 4, private finance. Now, there's 4 and 5 are both related to private finance. Number 4, I'm going to talk about a private loan agreement, and number 5, I'm going to talk about a private JV agreement. So let's talk about a loan agreement. Now, a loan agreement is really simple. It's when you borrow a set amount of money for a set period of time at a set rate of return. So let me give you an example of a loan agreement. Hi, I want to borrow £300,000 and I want to borrow it for 1 year and I want to borrow it at 10%, and that's it. So we've got a set amount of money, £300,000, period of time, 12 months, or you could still do it on a rolling monthly interest basis as well. And also, I'm going to pay it at this rate of return. So you've agreed all of that up front. So there's complete clarity. Now, the pros of a loan agreement. Firstly, if you're working with a private investor, generally you're going to have more return yourself. If you do a loan agreement, it's generally a bit more falls onto your side. So that's good for you from a financial perspective. But actually, it's a lot clearer for everyone what's going on. So as an investor, a lot of people think, oh, well, my investor's going to want to split the profit. Actually, a lot of investors don't want to split the profit, because that means they now need to keep track of how much money you're spending, how much money the project's going to be worth. They're banking on you getting this all right. Whereas if you're doing a loan agreement, no matter what happens, they are getting an exact amount of money. They know where they stand. And so loan agreements, in my opinion, are the best sort of private finance. I use loan agreements on a regular basis and they're super simple. It's a win-win. Now, the big mental block that some people have to get over is they think, when I take a loan from a private investor, they're doing me a favor, and so they come with their towel between their legs, please sir, can I have some more? When actually, you're doing them a favor. There's a lot of people, believe me, I speak to them on a daily basis, that have got lumps of cash in their bank accounts, business accounts, personal accounts, that they do not know what to do with them. And you are saying to them, that lump of cash that you got, Rather than leaving it in your bank for a measly 2%, 3% return, if you're lucky, I will give you 10% return on that cash. That's a massive win. And I'm just giving you 10% as an example. In this current climate, at the time we're filming this video, I would say anywhere between 8 to 12% is a good rate. But I've got a coaching client who's gone and secured a private investor a sub 5%, which is insane. So sky's the limit when you're negotiating. Equally, I've seen people go and pay 15 or 18% for a complex project where they're looking for 100% funding. So that's something, there's not really a hard and fast rule. I generally aim for between 10 and 12 myself. I want to give someone enough money that when they finish the deal, they feel like they've won and they want to come back when I ask them to borrow money again. Because the trick here, you don't have to find 4, 5, 6, 7 investors to do 4, 5, 6, 7 deals. You need 1 or 2 that are happy to continually give their money back to you so you can keep making them a return while you're making yourself a return. So that's a loan agreement. It's a super simple contract. Now, it doesn't matter if you're getting it from your Auntie Sheila. I still strongly recommend that you put a loan agreement in place, because remember, good contracts protect good friendships. So if you're going to do business with family, if you're going to do business with friends, and by the way, they're the first people you should tap up and ask if they want to be involved. They're also often the last people that will invest after they've seen you get everyone else returns, but they are the first people that you should ask. Still make sure you've got the correct contracts and agreements in place. Super, super, super important. It's a sign of respect, not a sign of disrespect to do that. Everyone knows where they stand. Everyone knows what's happening. So that's a loan agreement. Loan agreements, in my opinion, absolutely fantastic. Great way to get ahead. Then number 5, you've got JV or joint venture agreements. Now these are what we do when we do a profit share. So let's take the property that we're in. You know, let's say I need 300 grand in. It was just near enough to the figures. So 259 to buy, it was 34,000 to refurb, about 10 grand's worth of stamp, so it's probably a little bit more than that. But let's say I needed 300,000 from a private investor and it's going to sell at 400,000 at the end. When I'm doing a joint venture, what I'm saying is I will split that profit with you. That 100k profit we're going to make, we'll go 50-50. And by the way, a lot of people ask me this question, what's the usual split up, what's fair, what percentage? And it's super simple in my opinion. If it's clean cut as somebody's given the money and somebody else is finding the deal and carrying out and executing the project, that's a 50-50 agreement. They get 50% of the profit, you get 50% of the profit. I don't really think any other setup is fair there. Don't get me wrong, if they're involved or you're both putting bits of cash, it gets a bit more complicated. You're gonna have to figure that out. But in simple terms, 50-50 agreement, joint venture, and you're splitting the profit. Now, you do need to be aware of regulations when you go into joint venture. So this is one of the, not cons, but one of the things you need to be aware of is that when you start taking money from a joint venture investor, you've got a legal obligation to carry out your anti-money laundering checks to make sure that they are either high net worth or a sophisticated investor. And that's super critical, and you need to look at the definitions on the FCA website and what constitutes being high net worth or a sophisticated investor. But in order to give you money as an investment, they have to meet the criteria for one of those, and they'll have to self-certify that they are one of those. And the reason is, what you're now saying to them is put money into the deal and you'll be paid a rate of return depending on how successful the deal is. So that is by definition an investment. Whereas on number 4, what we were offering was a straight up loan. Remember, set amount of money, set period of time, set rate of return. This time we don't have a set rate of return. So for that reason, you need to make sure, what the FCA is saying is you need to make sure this person understands the agreement that they're going into. Now, again, my preference, where possible, is a loan agreement. But you will occasionally get people that are a bit interested in the deal. Maybe they're quite savvy and they realize, hold on a minute, I don't want to lend you 300k at 1% a month for 6 months and get 18k when I could lend you 300k and get 50k. But make sure you really have a good relationship then with the joint venture investor, because you're going to be, metaphorically speaking or financially speaking, in bed with that person. And what's going to be really important is how well do you get along, because rightfully so, they're going to need to understand the project. You're going to need to be able to say to them where you spent your cash and be able to demonstrate how you've done your numbers. How are you certain that the final value is going to be this? If this, then that. And go through all of the different confounding variables. It's a lot more involved than a loan agreement, where most of the time, with the loan agreements that I've had with investors or with private financiers, most of the time, they've just let me get on with it. Whereas a joint venture investor would be a bit crazy to just let you get on with it because their money and their profit is completely at stake. So that's the 5 different ways you can fund a property deal. Number 1, you've got cash money. Make it rain. Number 2, you've got a mortgage, super simple vanilla stuff, but great if you've got cash and you just wanted to scale up and build a portfolio in a straightforward way. Number 3, you've got bridging finance, a great way to bridge a deal. However, you do have to be aware that there's fees involved and you do need to make sure you know the contracts and agreements you're getting into. Number 4, you've got private finance, personal favorite of mine. Definitely a great way to find and fund. And also one of the things I didn't mention about private finance and JV that makes it a pro above, for example, bridging, is you don't have that criteria or that necessity to put a deposit down. It's quite a big thing. So if you don't have a penny and you want to go and buy a free 400 grand house or 200 or 100 grand house or a £1 million house, it doesn't really matter, then you can go and ask for 100% funding from a private investor, which you can't generally do from most bridging lenders. So that is a really key element or a key pro to number 4 and 5. So number 4, we had a loan agreement with a private investor, and number 5, we got a joint venture agreement with a private investor. So let me know in the comments which one of those you think is most suitable for you, which one of those is of most interest to you. If you like this content, don't forget, like and subscribe. It helps me to not only share this message with you, but to show this message and share this information of financial freedom with other people as well. In the meantime, what can I say apart from you're welcome?